Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content. I'm Keith McCullough, and welcome to The Pitch. For those of you that have not seen The Pitch, it's tight, all right? We got 6 analysts, 60 minutes, 6 ideas, and if they don't keep it tight, I cut them off, right? Todd Jordan, you get to go first, one of my good buddies, and a veteran at Hedgeye, great stock picker. Go for it, man.
And by veteran, he means very old. Thanks, Keith. Yeah, this is great. I'm really excited about this. So I'm going to talk about Penn Gaming.
Nice.
Which is probably my favorite stock right now. Is my favorite stock, and that's why I'm presenting it. But if we look at the slides, I'm just going to go through these really quick. Slide 4, just list out the catalysts. And what I really like about the story is the business, regional gaming, is so much different than it was just a few years ago pre-COVID for really 3 reasons, right? The cost structure in the brick and mortar business is completely different. And it's going to remain low, despite the skepticism out in the street. Second, you've introduced this core brick and mortar business to a younger demographic because there was no other alternatives for people to go to during the pandemic, and a lot of younger people started going to these casinos because they were open because the states needed tax dollars. So they closed everything else and left the casinos open. So it was fascinating that they've got this younger demographic now, which was always our big complaint against regional gaming, is that their customers were essentially dying because they were all baby boomers. And here now we're in a period where not only did they attract the millennials during the COVID period, the millennials are coming back. They like the product, so that's great. And the third piece of what I like about this is, and why it's so much different than it was pre-COVID, is the online sports betting and iGaming business, which is a huge growth business long term. And even though I'm not ragingly positive on the sports betting business just in the very near term, because I think the comps are very difficult, there's going to be a ton of marketing spend overall. Penn's niche within this is fascinating because their stock has gotten hammered because their market share isn't where people wanted it to be. But they laid this out. This is not a company that's going to spend billions of dollars to generate free play and advertising all over the place. They have a core business in sports betting that is related to Barstool, which has 60 million social media following. So it doesn't matter what your market share is now. It matters what it will be after all of this spending and whatnot is gone. And people are going to gravitate toward the brands they know. Right now, they're gravitating to who's spending the most money. But I think the market share picture looks pretty good for Penn coming up here, and they're going to outperform during football season. Their recognition is getting better, and they're in a ton of new states. And you can see all these catalysts are outlined on slide 4. So not only do we believe the core business is going to really sustain itself, so organic growth on the top line from a younger demographic, margin structure, very, very high margins, very low cost structure. We're not adding buffets, which is the loss leader. That's not happening anymore. So Penn is primarily a gaming company, and they will generate a ton of flow through on the incremental revenues because they'll be able to keep their cost structure low. And then you've got this great long-term opportunity. So those are the outlines. You can see from the stock chart on the right, Penn stock got hammered for some stylistic reasons, and also just because of disappointment in the online sports betting business. But good news is they're in a bunch of new states. Like we predicted, they would be in the second half of this year. They're already in 4 new states just in the second half of the year. There's potential for 3 or 4 more. And that'll be great for Penn's overall market share, and also give them efficiency on the ad spend side. If you go to the next chart, there's also been the Delta variant impact, but our analysis here suggests, if you look at August, despite like the Delta variant raging, you still had positive growth from 2019 on the top line. Now, it wasn't as good as July. July was just off the charts, but we're already seeing September actually bouncing back quite nicely. And you can see the COVID situation in the regional gaming states on the chart on the right looks a lot better, right? So we do expect the business to pick up. Next slide here is just a quick margin slide. So you're looking at non-gaming versus gaming. The good news is Penn is mostly gaming. That has the highest margin, but even their non-gaming margins are much higher than pre-COVID. So that's good. Next slide is just the new model versus the old model in regional gaming, and it incorporates everything. Everything is tied together. That's why it's called omni-channel. You got sports betting. Everything's the iGaming, on-site retail sports betting, and also the core brick and mortar business all ties together. All brand name, and Barstool is a fantastic brand to have. And then the next slide, finally, we'll just give you a snapshot of why we think Barstool and Penn together will be very successful in sports betting. They have all of the important factors. And then finally, the last slide is just our sum of the parts. And you can see we see a ton of upside here, 75% upside in the stock. And we're not stretching these multiples to get there. This is growth and appreciation of hidden assets, including Barstool, including their media business. And that is my prepared remarks. Turn it to you, Keith.
So tight. So tight, the veteran. 6 minutes or less, never mind 10. Couple questions. First, on factor exposures. So you mentioned it, you said some factor exposures. High beta, it's like a 2 beta stock, which is very high, actually. It's higher than what I thought it was. High short interest, which is 9%. That surprised me as well, TJ. Those are both the beta and the short interest have gone up. And again, when it factors from a quality versus non-quality balance sheet perspective, it's going to be in the wrong box for Quad 3 as well. Do you need Quad 3 to go away for this to really work?
Yeah, I mean, it's possible. We've always found, right, just working with you, Keith, that, a lot of the stylistic factors and factors that you look at can dominate over periods of time. But the good news for Penn, it's like, I think historically, it looked more like a bad stock in Quad 3. But, the thing is now there's tons of organic growth here, and there's organic growth in the core business. So it is a little bit of a better business model. And I do see the earnings estimates out there look really, really low to me. So not only do you have this organic growth, you have a lot of skepticism, which has kept the multiple down. So, look, we'd much rather be in a Quad 1 or Quad 2 environment. But I do think the stock, because of the new position it's in, could work. Maybe not as well, again, in those other quads, but still could work in that environment.
Well, what's interesting about that, too, and I just note, what I like about the pitch, for those of you that don't know, is that I'm actually doing some of my own work while they're talking, just to find some things that I'll look for. There's some real growth investors that own this. Barron, for example, one of the better gaming investors of all time, Ron Barron's firm, that is. So the Barron Growth Fund owns it. Fidelity put it in their blue chip growth fund, and recently, it's actually found its way into some growth funds. But this has typically not been a growth stock, to your point.
Yeah. No, not at all. It's a great point. It was when I covered these stocks before COVID. I had this top line thesis like demographics are terrible, right? You're looking to buy it on other things like stock gets pummeled, but they're using their free cash flow and high ROI opportunities. Maybe that'll drive the stock. But it was more like trades. You have this big wave of demographics going against them. That's all changed now. The interesting thing is it is very much a growth company, but they are generating just massive amounts of free cash flow in their core business. And EBITDA and free cash is so much higher than what the street is projecting, and so much higher than it was before. So you have this, you kind of like this multi attraction, to different kinds of investors right now. Yeah. And it's interesting you pointed out about the growth investors. I didn't know that. That's really interesting, because that should be actually more. That should be happening more so. Like, I think you should see more growth investors getting into this stock, because it isn't your father's regional gaming stock. No, not when you have 60 million Barstool viewers. No, that's certainly not when my dad's watching. But that's good. And I guess last question on that one. We only have a minute, but again, how does the money flow on the ad dollars there? I mean, those guys generate so much organic, action and everything from Instagram and back again. Yeah, so their customer acquisition costs are much lower than anybody else in the sports betting industry, and I actually think people are going to start paying attention to that, and that's why a little bit why I'm negative on the space in the near term, in that you're going to see all this marketing spend, but at the same time, it's really going to differentiate Penn from the other sectors. So Penn will be a slow grinder in terms of market share, right? A lot of other companies are going to be losing market share, or their market share is just going to move around based upon how much money they spend, which is so transitory. It's so temporary. Penn's building for the long term. And the good news is the expectations are so low. And that's why the stock has gotten creamed, because people were disappointed. Even though they laid out the structure, they laid out the plan, it was going to be a deliberate strategy. And I think people expectations got too high when the stock was at 140. So I think we're in a good spot versus sentiment right now.
Yeah, CEO sold it right at 140. That was a nice sale, actually. But I have it on the risk range going easily towards 90 just as a first stop. That's just on like the very immediate term risk range. So great spot to be buying. It's actually right at the low end of the range, or it was on Friday and on the open today. That has since gone because Todd Jordan has spoken. Thank you, sir. All right.
Thank you.
Felix, you notice that? See, he kept it to 6 minutes, so he got 3 questions instead of none.
Yeah, I'm going to keep it tight as well. So my 5-minute pitch is on long Pinduoduo, ticker is PDD. PDD was my biggest winner last year. In fact, I named my bird after it. Let's see if he's pushed on here. Say hi, everyone.
Oh boy, you brought back the bird.
So he's shy, but also can be super grumpy at times. So hopefully he'll be quiet. But this year, I've been kind of neutral on PDD since March. Obviously, the regulations do matter, but also that the new management team made several key mistakes in their strategic planning, in my opinion. However, a few weeks ago, I put PDD back on my long list, around $90, after they rectified some of those mistakes, which I outlined in a flash call to clients last month. For those who don't know about PDD, PDD is a social e-commerce disruptor in China and has blossomed into the biggest shopper platform in the world. To better understand PDD's competitive edge here, let's look at this subsidy purchase cycle on this chart. So this is just fancy words for group buying. And we were, one of the earliest people to point out the power of group buying in China. And PDD perfected the concept of group buying, which is bolstered by its 10 billion RMB subsidy program. Now, more and more platforms are copying PDD on what they're doing, but I will argue it's hard for customers and consumers to change habits and move from one platform to another. So it's good that PDD already has that early mover advantage. So here's how it works. So imagine you saw a great deal from Pinduoduo for a batch of apples on social media, and you think it's a great deal. So you go to PDD's direct app or PDD's mini app in WeChat to make that purchase. Now, WeChat's ecosystem is gigantic, so the cost of obtaining a shopper there is actually quite low. So when you see that deal for that batch of apples and you see the subsidy rate on those apples and realize if another person joins you and buys those same batch of apples via group buying, both of you get an even bigger discount. So, and then after receiving those apples, you'll start to trust PDD more because you're like, all right, these apples are pretty good and they're what they were defined as and promoted. So you promote PDD to your friends, and most importantly, you may now repurchase on PDD's platform. This is very key because if the shopper doesn't repurchase, particularly to like higher margin products, then PDD will have difficulty getting profit from that customer. But the good news for PDD is the repurchase rates are going higher. So the whole cycle begins again with another shopper, and it can get quite addicting shopping. Right now, PDD is putting the consumer interest ahead of the merchants. That could be dangerous, but for a brand that has trouble gaining shopper interest in the past, that's a necessary adjustment. So very quickly on the next slide, you would think that merchants will turn away, right? Quite the opposite. PDD has had a very successful subsidy campaign, and as I mentioned before, it's the biggest shopper platform in the world. So that means merchants will have to advertise more on PDD because they have the biggest shopper platform in the world. On the third slide, you can, if you go to the next slide, they're also raising the take rate. This was a note I wrote in May about PDD basically raising the take rate for many of its merchants for its 10 billion subsidy plan. It's still lower than some of its peers like Tmall. Basically, this is the right move for PDD because they're trying to upgrade their image to a more respectable e-commerce platform with good products. So this is a good thing. In addition, PDD is benefiting from the eradication of Alibaba's choose one of two rule, which frees up merchants to try other platforms. And the good thing is apparently it didn't discourage new merchants from being on PDD. And then lastly, I'll just share very quickly is, the biggest surprise from their earnings report was on the marketing side. For the first time ever, PDD showed a sequential reduction in its cost of buyer acquisition. So yes, management said this was going to be kind of like a one-off, but it showed that PDD doesn't need to spend crazy amounts of money and subsidy to buy users and to retain users. So for the rest of the year, I think it's more normalized spending, but don't be surprised if PDD can find more marketing efficiencies along the way. When you have over 850 million shoppers, you definitely have more options to work with. So that's all I wanted to say, Keith.
Yeah, well, for those of you that don't know, Felix was trained to a degree by the Todd Jordan. That's why he keeps it tight. Now, you will see examples that aren't as tight, but what you will not get is another Chinese internet or any Chinese stock idea from anybody else. So on that, I wonder, this stock was really, first of all, you nailed it the first time. It went to north of $200. Even CNBC noticed it, where they started calling Pinduoduo, which is the name of your bird. They start calling it Pinduoduo because they like the chart. But the fact of the matter is it's not well understood. It's not well owned in the U.S. I look at the same ownership screen that I did with Jordan, and you find that really next there's Bailey Gifford owns it. Tiger Management owns it, which is a sharp investor. But beyond that, it's hard to find somebody that owns north of 1% of this stock, Felix.
Yeah, it's still relatively unknown. It's better known now because its market cap has definitely ballooned.
90 billion.
And yeah, it's huge now. So it's definitely on everybody's radar. But again, it's a Chinese company, so you have to really understand it a little bit better, which can be kind of tricky because of the ecosystem it belongs in. But the main reason probably not many more long-onlys probably are looking at this is because they're still skeptical that PDD can retain and maintain its leadership in e-commerce. Nobody gave this platform any shot when they fought against Alibaba 2 years ago, or even last year. People laughed it off. Baba has a lot of arsenal of options that they can just bash this, startup. Turned out to be quite wrong. Now PDD is definitely on everybody's radar. It's just become a very, very fiercely competitive in this area. But I believe if they can continue to do the things that they are good at in terms of attracting shoppers, and don't do things that they're not good at, I feel like this stock will continue to work. I'm saying this pretty simplistically, but it's actually really important because management did make some really mind-boggling mistakes after the CEO left. Mm-hmm. So hopefully, now they're going back to what makes PDD.
Yeah, I'd like to go back to, I'm sure everybody knows, feeding the old ducks in this one. This thing was he's talking his own bird, but we like to feed the ducks. For those of you that don't know, when we start getting something right, we sell some to people. But again, you want to be buying them on down days. Last point on this is that if you were to just take this stock on its factor exposures, and no, China is a factor exposure that's been bearish, but it's starting to turn somewhat. Low beta, it's a 0.7 beta, like we discussed, 92 billion in market cap, which may or may not surprise people. Very low short interest. So all those factors really do work when you're in a quad 3 environment, and that's really the quad 3 environment that China's in as much as the US right now. I'm actually surprised that the machine hasn't fallen in love with it fast enough, and maybe it's just China exposure. Do you get a lot of questions from institutional investors on this in the US or no?
Yeah, a ton last year, this year, because of one reason of, as you nailed it on the quad 3 in China, but also regulations.
All right.
E-commerce is an area where there's a ton of regulations. It's still being regulated. There's a lot of new areas of e-commerce where the government quite doesn't really understand it yet. So they're getting to it. For example, live streaming is a relatively new concept in e-commerce. So regulation guidelines are going to come. They're going to continue to come. Maybe that's scaring some people away. I get it. But I also think the stock has been, absolutely destroyed this year. So at some point it becomes more of it is a growth company, but at some point, a lot of the risk to me is maybe already priced in. Mm-hmm. And if it can continue to grow on the user side, that matters the most and the revenue in the user side, but also now become more of a profitability type of thesis as well that's attached to Pinduoduo. So that offsets the regulatory risk, in my opinion. But Yeah, the regulator, until the government, gives a clear signal that regulations are not going to get any worse, I think people are a little bit more cautious on names like this one.
Yeah, and if you want to, the way that I'd set it up, if I'm running this in my own book, I cannot because my analysts have views on it, so I can't trade that in my own book. You just take out the China factor exposure by shorting ASHR or FXI, which are the big Chinese ETFs, so you can go straight up neutral on the stock long side against something like that. All right, thank you, Felix. Mr. Steinbomber, for those of you that don't know Josh Steiner, he doesn't look like maybe the Steinbomber, but that's his nickname internally. Go for it, man.
All right, yeah. So this morning we're going to talk about a large cap company, Visa, and this is a rare moment in time, I think, where you get sort of this confluence of two negatives that have really pushed the stock down 10%. And if you look back over time, over the last, basically since the company came public a little over a decade ago, there haven't been many opportunities to buy this stock on a pullback of north of 10%. So let's take a look at why the stock's down. First thing to sort of flag is on slide 17 here. So this is the quad setup. Quad 2 is the best environment for Visa, but as we'll see in a moment, Visa is really an all-weather stock. At least historically it has been. So we're in quad 3 now. Obviously, the outlook here brings us somewhat close to the origin over the next couple of quarters. But if we go to slide 18, we can see that really quads 1, 2, and 3 have historically always been favorable environments for Visa from a performance standpoint. Quad 4 is really the only environment where it's lagged, but even on an absolute and relative basis, it's still tended to outperform in quad 4. So the two big things out there in terms of why has the stock been weak of late, the first topic is BNPL. So BNPL is an acronym for Buy Now, Pay Later. It's been in the news a lot. I've been talking about it a lot lately. There was a day when there was a major deal. So Square acquired Afterpay, one of the largest BNPL providers. On that same day, the entire payments complex from Visa to MasterCard to the big merchant acquirers all just got absolutely smoked. And just in talking with people, a lot of the view for why that happened was concern that somehow BNPL was really going to be this massive disruptive force, was going to basically elbow the big networks, Visa and MasterCard, out of the position that they're in. So we've got a couple slides here where we'll just sort of take a quick look. So first slide 20, BNPL, is Visa a donor or beneficiary of BNPL? So first thing to realize is that just about all the rails of BNPL actually ride on Visa and MasterCard. So I don't think they are a donor of share here. We've got a couple comments there at the bottom. 90% of Afterpay's installment payments, so that's after you buy it, when you repay it, 90% of those are done using a debit card. So debit cards run over Visa and MasterCard rails, primarily Visa rails. And then secondly, PayPal is saying that 20% of their BNPL volume is actually done over credit. And then a good chunk of what's left over is also done over debit. So the ideal for BNPL would be ACH, which does sidestep those rails. But the reality is most of it is still done over Visa and MasterCard rails. Next slide 21. This is really sort of a frame up of this idea that the BNPL providers are sort of projecting, which is that we have this closed loop opportunity, which gives us sort of this, secure value proposition. But the reality is that a network is the value of the square of its nodes. And these BNPL closed loop networks are very small. And so ultimately, what's going to benefit them the most is to continue to be on the Visa and MasterCard rail system. If we go to the next slide, the other thing for merchants to realize here is the cost of doing business with BNPL. So typically merchants are going to pay anywhere from 2 to 3% MDR, merchant discount rate, to ride over the network rails. Here you can see what the cost of doing business is with BNPL providers. Affirm charges up to 8% plus 30 cents per transaction, Afterpay up to 6%, and so on and so forth. So this is not a low-cost option for merchants. Next thing, slide 23, is that we still haven't seen a full cycle here with BNPL, meaning a credit cycle. So obviously this last pandemic-driven event did not turn out to be a credit cycle because of the amount of money that was pumped directly to the consumer. So, the issue is, as you can see on the right there on slide 23, that the majority of BNPL providers are subprime borrowers. And as a result, 34% have fallen behind on a payment already. And that's in an environment that's generally favorable. Slide 24, not everything that's new turns out to be disruptive. So this is a look at Apple Pay trends over time. So you can see from 2015 to 2021, the adoption rate of consumers who have devices that support Apple Pay has gone from 11% to 43%. The percent of merchants who accept Apple Pay has gone from 19 to 70%. Meanwhile, the percent of people who use Apple Pay has gone from 5% to 6%. So be careful about jumping too far forward in conclusions. Slide 25 is just a snapshot of Global Payments CEO comments on what is perceived as new is really not that new. I won't spend too much time there. Next couple slides are just a look at Visa's actual trends, what we've been seeing in terms of cross-border activity. This has been the other side. So there's been concern over BNPL. There's also been concern over Delta, and specifically Delta slows down cross-border transactions, which is about a third of Visa's business. So that's an important component as well. But if we look at these slides, slide 28, 29, we can see that those businesses are actually still rebounding. There's a little bit of a let off here in August, but we'll get to why in a second. We think that's temporary. So quickly, an update on COVID. Slide 31. Americans are eager to hit the road here on Labor Day. Slide 32. Daily new cases of COVID in the U.S. actually rolling over. So we are looking like we're past peak here. Slide 33. When you put together so this is a survey based on blood donations where they can identify seroprevalence of people who have actually had COVID as opposed to being vaccinated for it. There's a distinction. And when you look at that, 20% of blood donations are from people who have actually had it. That's through May of this year. And then a further 60% have been vaccinated. So you put those two together and you're up around 80%. So it does seem like we're actually pretty close to herd immunity. And again, cases are rolling over. And that's not just in the US, but if we look globally on slide 34, you see that trend as well. So Delta is rolling over at a global level as well as in the US. So we think all of that is going to bode well for cross-border renormalization for Visa. Again, this is one of the biggest hang-ups in the stock of late. And then finally on slide 35, this is our proprietary AI system, and it is currently ranking Visa almost at its highest level that it's ever seen from an opportunity standpoint over the trailing decade plus. So those are my slides. I'll leave it there.
Well, that doesn't happen because the bloody thing doesn't correct. I mean, that's the problem, right? I mean, it actually has some perceived issues that you could perceive. I mean, there's $480 billion in market cap between Vanguard, T. Rowe, and BlackRock. They own 15% of the stock. It's not like these other stocks that we need them to get them into the ownership group. So I guess that's just what it is. I mean, for me, its tail is 218, long-term tail. Support is still there, but it's in between that. The trend, 220 or 231 is trend. So I guess what you're saying is if it gets above 231, it's going to go back to all-time highs.
That's the idea, yeah. And we think fundamentally that's the setup. We think that with Delta rolling over, and we talk about this, you and I, Keith, on the macro side, the idea that suppression in activity in Q3 is going to lead to more likely a stronger bounce back in Q4.
Yeah.
And that's really the setup here for Visa as well.
I mean, I still think, we just did a big client call. You were on it, obviously, institutional client call. And, pushing people to think about how good the fourth quarter could be and Q3 earnings season gets reported right in front of that, that's a big deal. And Visa is obviously going to have an opportunity to speak to those things on their call. So good. It's not every day you get to buy one that everybody kind of knows what it is. That's Visa, and you rarely get a correction. Thank you, sir. Mr. Penney, are you pitching a short idea? Or you got along?
I am going short today, Keith. Absolutely.
You've never done such a thing.
Never. So Shake Shack, I'm talking about Shake Shack, been on a best idea short list for a little while. I've had a lot of negative comments over the years about Shake Shack and the way the company's managed, frankly. But all of my sort of concerns over Shake Shack were confirmed when I was doing the work on Bros, which is BROS, which is a company that's going to be coming public here, Dutch Bros. So my comment or my tagline for today is Shake is a Bros wannabe. And I'll go through that in a second. And it's important because there's all these different elements of these restaurant companies, especially these smaller cap, and these are 3.3 billion-dollar companies that you want to see. You want to check a box to make sure you don't have any red flags. And Shake Shack for years have checked all those boxes, and Dutch Bros actually does the exact opposite. So on slide 39, just a little bit of background. I don't want to spend too much time on Bros, but on 39.
Well, you do like Bros, right? It's like it's not like you're not
Bros.
pitching Bros. Yeah, it's new. It's a new.
No, I'm not pitching it, but you'll see in a second why Bros is awesome when I just pit it against Shake Shack. You'll see why Shake Shack is a disaster and why Bros is a long. First, on slide 39, you can see the monthly comps for Bros. They weren't a COVID disaster. They actually did really well during COVID. They had a lot of drive-throughs, which is obvious or important in this if you didn't understand it. Slide 40 is the Shake Shack quarterly comps. You can see they had a fairly disastrous numbers. And I want to, instead of coming back to this, Keith, I just want to point to the March 22 inflection point higher. So these are consensus estimates for Shake Shack. And for some reason, consensus has within 6 months this massive inflection point higher in comps. Now, for what reason? I have no idea, because if you look at the next slide, this is taken from their latest press release on their earnings call. There is no recovery anywhere in the system. So if you look at the red lines, which are, the dotted lines represent 2021 versus 2019, you hear a lot about Todd and Josh and, a lot of the consumer analysts, myself included, talking about companies that have significantly recovered versus 2019, not just the easy comparisons of 2020, right? But so Shake Shack isn't recovering. And there's a lot of reasons like that for that, frankly. I won't go into all of them other than, it's very urban. New York City is 30% of the locations. New York City's not coming back anytime soon. Coming back to the office, is going to be piecemeal. Everybody that I talk to, my son, who works in the industry, and everybody else works in the industry, we're talking about January before people are coming back to the office. So New York City's not going to come back anytime soon. And then the other piece of this is Shake Shack was really slow with the digital adoption, and that is already slowing. And this is a really important component for the restaurant industry going forward, is that you really see a higher component of sales coming from digital. And you can see on the right-hand side, again, from their slides, their digital mix is slowing as opposed to everybody else is growing. And then on the left-hand side, you can see the monthly average unit for Shake Shack is in just a massive deceleration. So just to sum it up, why I think Bros is a Shake Shack, or why Shack is a Bros wannabe. As of June of this year, there were 471 shops in 11 states. That's for Bros. Virtually half and half franchised. Shake Shack has about the same number of stores, a little less. They do higher average unit volumes, 339 in 50 states and 15 countries. And they're both coming at $19. Bros is going to be at a $3.1 billion valuation. Shake Shack is $3.37 billion. So you can see the parallels here. You've got companies that are virtually the same size, have virtually the same number of stores, except, right, Dutch Brothers store level contribution is 28% versus Shack at 18%. So that is a huge difference on return on new units. And that 18% is high because that's going to come down again in the next quarter. Average unit volumes, this is one of the most important points here. The Bros average unit volumes are higher in their core markets and new markets. So if you open up a store in Texas, which they are just starting to grow into, versus Oregon or Washington, where they're located, they're doing 30 to 50% higher volumes in new markets than the core market, which speaks to the quality of one of the companies and unit openings, but the acceptance of the brand in new markets. That is the exact opposite for Shake Shack. As a matter of fact, Shake Shack is core markets in New York, and they do 3, 4, and they're doing something of 2 on an annualized basis outside of New York. So Bros had 14 years of consecutive comps and still have positive comps in COVID. Shake Shack can barely get 2 years together. G&A per system wide store, this gets to the efficiencies of the companies, is 26%. So Bros is 26% more efficient on a G&A level per store than Shake Shack. EBITDA margins 18% versus 8%. And then you've got Bros at 19. We'll see if it price. I don't know what the right multiple is for Bros, but it's 44 times 22 versus Shake Shack at 58. So literally, this is a company, Bros, that checks every box that you want to see in a small cap restaurant that is doing really well, executing. It's got 40+% unit growth at the company level versus 19% for Shake Shack. So it confirms basically what this does is, one, it tells me I like Bros, but two, it confirms every concern I had about Shake Shack for the last 2 years, frankly, and why this stock is going to be in real trouble, especially as people do the work that we've done and comparing these two companies, and you're going to begin to ask questions of the Shake Shack management team. Well, they're doing this. Why can't you do that? So it's just this company coming public is going to raise a whole bunch of concerns for Shake Shack shareholders. And if you're Shake Shack shareholders, you actually want to buy this company, which has a much better future, Bros, than Shake Shack, and trade out of Shack and into Bros. So that's it.
Well, this stock, this gave my buddy Drawdown Josh Brown his nickname. This thing gets pounded when it gets this thing pre-COVID went to 40 at the end of 2018. It got smoked again pre-COVID, and it's had this unbelievable meteoric rise, but has since now broken down. Now you can say it's broken down on its factor exposure, small cap, high short interest, et cetera, everything you just said fundamentally on top of that. Or you could say it's going back to 40. This is
that's the number I would have picked. Yeah, that's the number I would have picked.
Would it be cheap at 40? It's not
No.
cheap. It's not cheap. Cheap is not the right catalyst, but
no, absolutely not. But you could make a valuation call for 3 years on this one, right? And you've gotten busted a number of times. But
yeah.
We're finally getting to the point where it's just becoming very obvious, and especially when you look at this company that's coming public, and there are others that are going to come public too, which are much better off than Shake Shack. There's just a whole new lineup of new companies that are just much better run than Shake Shack, and Bros is one of them. This is going to be probably the highest IPO in the consumer space, and certainly in the restaurant space.
Well, we have First Watch coming, which is also I'm sure everybody's who's eaten there. These are fads to a degree, and then they get overbuilt and they get overowned. This one though, why do New York asset managers own so much of the stock? Between 12 West, Fred Alger, and BlackRock, they own almost 40% of the stock. Is this were they given the stock in the beginning? What is this?
I don't. It's a gret question, and I can't answer that. I don't have any idea other than the obvious, right? Where its core business, its core market is New York.
Yeah.
So to the degree that people live and work in New York and they see the stores and how busy the stores may or may not be, we got to buy the stock for that reason. I guess. I can't explain it. It doesn't matter I don't understand it because the facts about the company are literally one of the worst that I've seen in my career. But yet, for some reason, it's a meme stock. It was caught up in the Wall Street Bros. Wall Street bets.
Bros. Every time you say Bros, I think about a different bro. The Bros own Shake Shack. It's like the Bros. This is just anyway. Danny Meyer's got 6% of the stock too. Maybe they just like to be hang out with Danny Meyer. I don't know.
Well, it's his company. He started it, so
yeah,
that's okay for him to own it.
Yeah, no, that's it's okay. He's famous and all that stuff. Okay. This thing looks awful. That's a very technical term on Trade Trend Tail. Looks terrible, awful, terrible, terribly awful. All right, thank you, Howard. And that Bros IPO looks good, and I think First Watch will look good too. Yeah, for those of you that don't subscribe to Howard's Consumables Pro product, he writes about all these, and I try to signal on as many of them as I can, and he is fantastic on the short side. Jay Van Sciver, you've got a short or a long?
I have a long, and we're gonna do Volvo in part because it's good and it's down and it's cheap, but many of the reasons that investors aren't looking at it are wrong. They're misinterpreting what's going on. Trucking capacity is extremely tight. Rates are the highest they've been. This is something that I think some people will know. But as GDP continues to recover, if you're already at 100% utilization, the tightness just gets worse, right? So you have a good outlook for a couple of years here into a robust truck market. Volvo's in the way of a number of really good industry trends. The fleet is old. The industry is very consolidated. But the weird thing about this industry is even though, say, 3 players hold 90%, they've never really extracted the margins you would expect for that kind of consolidation. And that's largely because of Daimler. And one of the best catalysts out there in the industrials landscape is the spin of Daimler Truck from Daimler, which I think will name itself Mercedes. And that is, as you go through their documents, a sign, I think, that Daimler Truck just plans to raise prices, right? And if they don't, they're pretty stupid. So that's a great catalyst. You could easily have a 50% margin increase in this industry across players over really a fairly short period, like a couple of years, if you do get pricing from Daimler, if they become the price leader. On 47, you can see quad setup. We're going out here, we're taking this risk on this catalyst, but from in a cyclical, this is a pretty great set of quad exposures. It doesn't get clobbered in quad 4 the way a lot of cyclicals do, and quad 3, it's a pretty good performer. In terms of what they do on 48 here, a lot of people think they make cars. They sold that business to Geely a long time ago. They make heavy duty trucks and construction equipment. It's these soccer moms for 18-wheeler soccer moms. Serious hockey practice, right? On 49, you can see how consolidated these industries are. And these are like the best of friends, or they should be, in an industry like this, right? If you really have 4 players in an industry that's as segmented as this is, right? There's over-the-road, vocational, there's different kinds of trucks, different competencies. They should be getting very high margins. And what you see is that they mostly don't on 50, right? They're okay. And actually, Volvo has good margins in the context of its Daimler, as you can see, as the price disruptor, mostly has the worst margins, even though it has the highest share. And the question is, if those come up to be in line with the industry or industry leading, you could easily get these into the mid-teens. On the construction equipment side, which is less relevant, Volvo also fares fine. A little bit below CAT, a little bit ahead of Deere most years. Fleets for our process, right? We'll just look at trucks for right now, 51. Fleets are old, right? And they're aging. So the rate of change means that you're under buying trucks. You need to buy more trucks to keep the age steady. And you're mostly starting out with a slightly older fleet, which is good for parts consumption. This is the part here that's really a problem for the economy. 52, you can see that little on the next slide there, 52. You'll see that truck utilization is at 100%, right? Like there aren't spare trucks. And that's because, there's a lot of reasons for that. Drivers, units, but in general, if you want to track drivers, younger units are better. And you're simply going to have to add capacity, because if you go out and you grow GDP 4%, you're going to roughly need 4% more trucks, and you don't have them. So you're actually seeing tonnage decline because of shortage of trucks. You just don't have. It's very hard to get people onto trucks, or your cargo onto trucks. On 53, you can see the rates, and they're the highest they've been. I mean, 2018 was considered obscenely high rates after hours of service went in. Electronic logging of hours ended up curtailing capacity because it turns out people were probably cheating. And now you're way above that. And you used to have on the right there the secular tailwind of people cramming, more stuff into the lanes, or increasing basically reducing the deadhead. So like if you have a truck that's coming back with a tractor empty, people got better at using technology, C.H. Robinson, Uber, Freight, or whatever, at filling that deadhead so you could pick up a load closer. A lot of that's been exploited. That's been going on for decades now, and you're not seeing that efficiency tailwind. So when the high utilization bites, it's really biting. Here you can see tonnage. You would expect this to be through the roof, and it should be through the roof. Rates are up. You simply don't have enough units. You don't have enough trucks going around to haul all the stuff that people want to haul. So you're seeing pressure on truckloads because you simply have capacity constraints. As a result, not shockingly, you're seeing on a very tiny slide 55, orders are going up for units, and you're seeing backlogs soar. So this is also under an environment which people think is a problem of component shortages. But lack of supply into a repricing catalyst like Daimler Truck spin is great. This isn't a bad thing. This is a good thing. People are going to feel like, I can't get a truck. Oh my God, I'll pay, what I need. I literally can't service my customers. I need trucks. And the reason that orders came down a bit is some of the OEMs were hesitant to accept orders for 2022, which is where our orders are now for, because they're sold out for 2021, obviously. They were waiting to get pricing in line. So they're waiting basically to figure out how much they can raise prices in 2022. I think that's a good catalyst. Inventories for new units, 56, very tight, echoes autos. 57, when you get to sort of like, where should Volvo trade? Like, why would Volvo trade at a discount to a CAT? Right? It really shouldn't. It has actually very similar growth dynamics. It's on the construction equipment side, they compete. But for whatever reason, Volvo has ended up the cheapest. That's not always the case either. Sometimes it's more of a middlingly valued name in the context. But it is down quite a bit relative to its peers, and just sort of down. And it's down, interestingly, into what I think is one of the best catalysts, which is here on 58, which is, if you've done industrials for a long time, when somebody who makes heavy duty trucks is talking about unlocking their potential and being a technology leader, it's like, dude, you make trucks, you got like 50% market share on over the road trucks. What you're talking about is raising prices, right? They want to get their financial prices up. Do you really think they're going to re-engineer a truck and take all this cost out in the next year? No, they're going to raise prices. Obviously, why wouldn't they? Should have raised prices earlier. So I think that's going to make this industry, the competitive intensity, come down and raise margins for everybody. Volvo and PACCAR obviously benefit from that. I think that's a tremendously underappreciated catalyst.
Well,
that's it.
In general, just these similar sets, as we call them in fractal math, between rates and pricing, it's not that complicated, really, if you actually just take a couple things that are similar. And people just don't know. I just, just had another conversation with an institutional client that kept telling me about supply shortages, and that's what's really creating a lot of the inflation. I'm like, that's fine. They don't just go away. Like, we can own them, right? Like, we can, I guess the case is what it is. But how long do you think, that one chart I had to get closer to just to make sure you started with it on rates, but I think it went back to 2001. These are very long cycles.
They are. And, you can bring capacity on or drivers on over time. But the problem is in, say, like 2018, 2019 environment, you were at kind of, as like growth was already decelerating in the back half of 2019, whereas at least in our macro forecast, we're still looking at kind of mid-single digit GDP growth year over year, which means the capacity is just going to get tighter. So if you have, say, a 2 million unit over-the-road fleet in the US, right, and GDP goes up 4%, that means you need an extra 80,000 trucks that year just to stay where you are. Forget dealing with the excess rates and deficits of supply. You're going to have replacement demand, which is 250,000 units, right? Because trucks get old, they break, they crash, all kinds of reasons people can't use the trucks they have. Or they get too expensive to maintain, they're totaled, all kinds of things happen. So about 250 a year die. And then you have, this extra 80 that will be associated with GDP growth. So you end up with what is an exceptionally good year, just because you have GDP growth or replacement demand, let alone all these other dynamics fixing the deficit.
One other that's so easy. I can understand it. The last question, a quick one, because we only have a minute on dividend yield. I always look for the capacity in the shareholder group to change, right? Like, in this case, it's unless I'm wrong. Like, prior to taking all this price, they have a 4% dividend yield. Correct me if I'm wrong. And one, if I'm not wrong, can that go a lot higher? And two, how much higher could that go?
Yeah, I keep thinking, like, in this current rate environment, 4% sounds fantastic, right?
No, exactly.
Where else are you getting 4%?
If I can't, I can't own this stock personally, but I'd buy it today just for that. And I'd trade it, But anyway, go ahead.
But I do think that if you get a reset in pricing in this industry, these companies will have a lot more profits to distribute And a lot of these we didn't talk about, but they're also bringing out electric trucks, so the potential for revaluation if they get sort of a electric truck premium, that's just a degree of freedom to the upside too.
Oh, electricity. They got to come up with a pitch on that. Some of the pitches we've seen on electricity are pretty creative, right, Jay? All right.
Yep.
Thank you very much. Ami, you there?
What's up, Keith? How you doing?
Good to see you, man. Go for it.
Thanks. Well, we're pitching a short today.
Oh.
Company, yeah.
Caught me off guard there. Go for it.
Company is a language learning app, and it is called Duolingo. Just came public a couple months ago under the ticker DUOL. It is an $8 billion market cap, fully diluted. If you look at slide 61, on the left-hand side there, you could see this is some of the product functions and features that you get as a user or as a subscriber of Duolingo. And on the right-hand side, you can see that in the last 2 years, their revenue went from $71 million to $162 million in 2020, from 2019 to 2020, definitely a COVID beneficiary. If you look on slide 62, there's our short thesis. The stock has had a really great short squeeze or squeeze, I should say, in the last few weeks, and it went up a lot. And we've talked to a lot of bulls and we've thought a lot about the bull case. And let me tell you the bull case. The bull case is optionality. Duolingo has had over 650 million mobile app downloads so far. We've tracked it to over 800 million total registered users having ever signed up. They currently have 236 million courses that are live, meaning someone has started a course. That could obviously be over a very long period of time, but someone has started a course. And they have only 1.9 million paying subs. So the optionality is that it'll get to 25 million subs or something like that. That's the long. Let me tell you why that's not going to happen. Because even in Duolingo's absolute best subscriber category, this is their best category, they have 60% annualized churn rates. That's not 60% retention, that's 60% annualized churn in their best category. And right now, actually I want to jump forward a couple of slides to slide 65, so it's three slides. Actually, right now, paid churn is growing faster than gross ads. So if we look at the top left chart, there's three charts here. So the top left, the red bar we're looking at the 1 year paid subscribers. So people who are on a 12-month subscription for Duolingo. The red bar are the number of churn subscribers. The gray bar is the net additions, and the black bar is the implied gross additions, right? So you could still see the gross additions are well above the red bar, and typically that's a good thing. But if you're paying attention to what the slope of that curve looks like, look at the bottom left chart, and just peeling that out, you can look and see the red bar is growing a heck of a lot faster than the black bar. And what does that mean in the end? That means growth slows. You look to the right-hand side, there's your red line for paying subs year-over-year percent. The black bars are the actual KPI that the company has given out. The blue bars are our estimations and our estimates for the future as well. So we see continued deceleration. First of all, how do I know that churn is going to stay relatively high for this area? Let's go to the next slide for a second. That's retention. So you see on the next slide, slide 66, you see this is mobile app retention from active sessions from the time you download it across a 90-day period of time. So on the left-hand side, you can see that Duolingo is actually better than pretty much all of their peers that they compete with in the mobile app language learning industry. It's a mouthful, sorry. But if you look at the right-hand side, they are like nowhere near the apps that they compare themselves to in terms of monetization potential, which is namely Spotify and Tinder. And you can all theorize for yourselves why someone would be less engaged in learning a language versus getting on Spotify or getting on Tinder. I'll leave it at that. But going back 2 slides now to just explain this, you're seeing the 1-year subs. I just showed you the 1-year paying subscribers churning on a lag, and that churn growing very fast now, because now we're comping in 3Q21 and 4Q21 and 1Q22. You're comping like full COVID beneficiary quarters, right, of 1-year subscribers who are now going to hit their 1-year mark and churn, right? So you're going to have a big churn window here for the next 3 quarters. So paid subscriber growth is going to slow considerably. And we know all of this, and we've already seen this happen with the non-paying subs. This is the free subs with who they monetize via ads. This is on slide 64. So you see the gray bars are gross new MAU. The black bars are net new MAU. This is the left-hand side. And the red line is the spiking trailing 12-month net churn. Now, why do I think that this not only will churn stay high, but the machine learning core of this application, which this application is built by former, computer science, their Carnegie Mellon PhDs, had sold a company to Google. They are famous people in the Valley, super duper computer scientists. How do I know that their genius is not going to find a way out and get to 25 million paying subs, even though you have 60% churn? And that's because if we look at slide 67, on the left-hand side, you see that this market, the language learning market, is estimated to be about 1.8 billion people worldwide currently learning a language. Well, guess what? Of that amount, that includes everyone in K-12 and everyone in universities as well. So the bulk of the paying power here is not in a market that Duolingo serves. Duolingo serves the hobbyist market, I want to improve my Spanish skills because I'm going to be in Costa Rica 6 weeks from now, or I need to learn English to get a job in the United States, or hobbyist, one-time use, occasional use. That category is a high churn market, and Duolingo has already touched, as I mentioned before, a massive part of this market with over 650 million downloads, over 800 million registered users, over 236 million active courses currently. And the front end of their engine, which is measured in monthly active users, already slowed before the pandemic considerably. That's the chart on the right-hand side of 67, already slowed considerably. It got a boost in 2020. But we expect it will grow mid-single digit in 2021. Actually, it declined 5% year over year in 2Q21. We think that'll just normalize. That was the tough comparison. But the point is that the front end of this engine isn't growing all that fast. So even if they throw a lot of tricks, a lot of ads, a lot of monetization using machine learning, they're trapped by the number of people who want to learn a language. And if you want to know what that means, just ask Rosetta Stone. And yes, Duolingo is better than Rosetta Stone because they've taken an online tool and they've turned it into a mobile tool that's gamified with machine learning at its core. But at the end of the day, it's still contingent on the number of people who want to or need to learn a language outside of K-12 and university. So in the hobbyist, not needing to learn, or one-time use needing to learn market. So that's our view on Duolingo. We think there's 50% downside because this has been completely misidentified.
This is not Ami's first rodeo shorting a new issue, and we only have time for one question, but the question I have is timing. I mean, you nailed, for example, UiPath. All these stocks at CNBC just parrots and has a story on. They don't have the red versus the black line, for example. They don't do the bottom-up work, but you have, and you could have easily been sucked into UiPath a lot higher, and now it's a lot lower now that they report reality. This company hasn't had to report anything yet. Do you think that they could have one good quarter before they have what you're painting as the future reality?
No, I don't think so. Not on the paid subscriber front.
Not even one?
Well, I think like the data, the MAU data is the mobile app download data has improved in August. and July. And we factored that in because, again, it's not going to stay down 5% year over year going forward. I mean, like we said, the MAU is going to grow. It's not going to be a massive growth engine like they had in 2020 thanks to COVID, but the front end of the engine will grow. It's just that right now they're facing that cliff of comparison on the 1 year subscribers who were at full strength in back half of 2020. Thanks to COVID, 1 year later, 60% churn. That's what's right ahead. And the gross ads aren't as good on that side right now.
And
in fact, they're down, as you can see.
That's what, and thank you for that reminder. That's what really, short selling's not easy. Ami and I both know that. We've been doing it for about the same amount of years. You add them up, it's like in dog years. He and I are going all exponential on you. But the fact of the matter is you do have to get the timing right. And if you do find a disconnect between the TAM, or the total addressable market that's being pitched to you on a different kind of a pitch, don't forget that all these companies are pitching you their stock. Okay? Never forget that. Jay Van Sciver is always quick to remind us that company is really in the business of selling stock. Now, again, so when somebody's trying to sell you their stock, understand it's different than an independent research provider like Hedgeye that's modeling everything top down, bottom up, fully loaded, and trying to get you the right answer, not to buy or sell a stock. We don't get paid anything on that. We get paid to help you risk manage these situations. And Ami's done a very good job on a lot of different storytellers out there. He and I, as good Canadian boys, we like to say, les raconteurs of the world. Those storytellers, right? Sometimes it's true, sometimes it's not. So thank you for tuning in. We think we're on the right side of these ideas, and we'll look forward to seeing you next time.